Welcome to Dollars and Cents, Creating Your Fulfilled Life with Nicole Romito from Private Vista. In this podcast, we draw from years of experience as well as guest specialists to help you create the life you imagine. Join us in this journey as we enlighten and empower you to align your lifestyle to help you achieve your goals with a clear picture of your future. Now, let's get to the show.
And welcome to the Dollars and Cents podcast with your host, Nicole Romito. Nicole, good to be with you again. How are you?
It's good to be with you too, Bill. I do have to say, I know normally we don't reference when we're getting together, but given it's December 4th, we at Private Vista, and I think everyone else is in the throes of the holidays and certainly finishing up a strong year, just trying to get through the year end here.
Well, strong finish is good. And yes, since Thanksgiving, I feel like I am in a rock rolling down a very steep hill. So I feel your craziness, but I am happy to know it's going well. That's good.
Yeah, I agree. I'll take good crazy all week long, if you will.
Amen.
And certainly talking about, I don't know if I want to use the word crazy, but certainly an action-packed year. We have Jeremy Bell is returning to our podcast studio today. So welcome back, Jeremy.
Thank you for having me.
Yeah, always appreciate your time and insights. And just for our listeners, to give them a little overview, as I mentioned, it's December 4th, so we are post-election here in the U.S., and the stock markets have been on a tear since then. Jeremy and I are going to talk about a review of 2024. While the election is the most recent big event in the U.S., there's certainly been a lot of ups and downs this year. So Jeremy is going to help us kind of just remember everything that occurred and then share some insights on what we might expect to see in 2025. Because I think, as I know all my clients know, my favorite F word this year is fluid. We continue to live in a very fluid world and environment. So that's why Jeremy and I did want to share. This is all as of December 4th. And kind of that's what's happened to date. And that's kind of what will be based on his thoughts and insights. So with that, I will give a brief overview of Jeremy in case our listeners did not hear his prior episode. Jeremy is a principal and the chief investment officer for Conway Investment Research. He joined the firm in 2011 and chairs their investment committee, which establishes the firm's investment philosophy and process and ultimately oversees the implementation of the recommendations they make to their clients. In addition to leading their research effort, his primary responsibilities include capital markets research, asset allocation modeling, alternative investment manager due diligence, and manager of key client relationships. Gosh, Jeremy, I thought I was a busy person. You got a lot going on there just on your day-to-day at Conway. Do you want to just maybe share a little bit about, I'm thinking maybe your 1 hour of free time that you have for friends and families when you're not helping Conway and your clients?
Yeah, no, it sounds busy, but, small firm, everybody's doing a lot of everything around here. So it's perfect. Everybody works hard and, created a great sort of entrepreneurial firm that, that we built starting about 14 years ago. So it's been great. Outside of work, I mean, a lot of it is chasing around two kids that are 13 and 10 and very active on the sports front. So, which I enjoy sort of watching them play, whether it's soccer, baseball, whatever it is that they're into at the moment.
Great. Well, good. Thanks for sharing a little bit about yourself. I know we have a lot we want to discuss, so let's just jump right in. And I think a good place to start is, we're almost done. We have a few more weeks left in 2024. Why don't we kind of unpack or review? I know you and I talked, there was a lot of big events this year. Do you want to start? Why don't we maybe start with the U.S. equity markets? I know most people are tuned into those. why don't we start there as kind of a year in review, if that's okay with you?
Yeah, that sounds great. So, I mean, looking at sort of performance, this would be as of yesterday's close. So as of December 3rd, Nicole, you certainly referenced a lot of big sort of political events that have taken place over the course of 2024. Probably most notable being the presidential election that, we just got through a couple weeks ago. But we've also has continued to have war in the Middle East. We continue to have fighting between Ukraine and Russia. You had events in South Korea yesterday.
Right.
So I think your description of everything is very fluid and global in nature. I think makes a lot of sense. But I think the important thing is if I look at U.S. Sort of financial markets, that I would say the U.S. has largely ignored all the noise that's out there. So if you look again, based on yesterday, you've got an S&P 500 up about 28.5%, the NASDAQ approaching 30%. Again, small caps, which have been big participants over the last couple months, particularly with Trump winning back the White House.
Right.
You've got small caps now up over 20%. So it's really been a strong year. You've seen contribution, certainly more from the growth side of things, more from the large caps, mainly the Mag 7 continue to sort of lead the market, or at least certain members of the Mag 7 continue to lead the market higher. But we're very encouraged by the last couple of months when you've seen greater participation, more of a broadening out of the market, as you would say, with value participating more, and again, small caps participating. We just continue to think we've been in this period, for well over a decade now of what we consider to be U.S. exceptionalism, and I think that's driven by just strong economic growth that we continue to see here in this country. And then, very, resilient and, strong earnings growth that, just in our opinion, really leads the rest of the world. And I think that's been a big driver of why capital, has flowed in and will continue to flow into sort of U.S. equity and U.S., fixed income markets going forward.
Okay. Yeah. I think, yeah, I agree. So we've talked a little bit about the equity markets and where some of the more commonly known indices are. Do you want to talk at all, just maybe give our listeners a review of what happened in the fixed income markets, since, generally that's a very sleepy part of the portfolio, right? A lot of my clients call that their mattress money or their sleep at night money. But we certainly, fixed income has been, I know where we've been focusing, or a lot of, opportunities and strategies as we've gone through, kind of rates certainly increasing significantly. And then the Fed has started to decrease. I think a lot of what you and I talked about is, are we going to be higher for longer? But I think I'm getting ahead of us. Maybe just give a quick overview of what happened on the U.S. bond markets this year.
Yeah, I think the easiest way to probably describe it is there's, interest rate volatility has been very, very high. And that's really dating back the last couple of years when the Fed began hiking rates, in 2022. But this interest rate volatility, whether it's in, treasury markets, primarily in treasury markets, has really continued throughout the year. I mean, some of the moves that you see on a day-by-day basis with, probably the most notable gauge in the world being the 10-year treasury, very sizable moves on a day-by-day basis, depending on market events, economic data points that come out, et cetera. But when it's all said and done, I mean, you're correct that the Fed hiked rates, to a high of, 5.25% to 5.5% was sort of the Fed fund target range that they ultimately got to earlier this year. But then then we've sort of over the last 3 months started into this rate easing cycle where the Fed in October cut, 50 basis points. Followed it up at their next meeting with a 25 basis point rate cut. And then I think markets are pricing in about a 60 to 65% chance of a 25 basis point rate cut here at their December meeting. So, you've come down theoretically into the low, 4% sort of range on the Fed fund rate. I think you've seen treasuries sort of follow at least that a little bit lower, but for the most part, I mean, things have been pretty range bound if you look at interest rates for most of the year. But one area that I think is important to highlight is credit has remained very resilient, just on the back of corporate fundamentals remain pretty healthy. The default cycle that was widely anticipated has never really played out. Companies, for the most part, have been pretty good about managing debt on their balance sheet and pushing out, any refinancing sort of maturity walls that are out there. And it's been largely a year within credit markets of sort of clipping coupons and,
Right.
with higher starting yields to begin 2024, even though you've seen the 10-year Treasury move higher. It started the year at 3.88. We're currently sitting at about 4.2. We've certainly been as high as about 4.5. We've been as low as about 3.6. So again, highlighting that volatility, but overall, 10-year rates are higher on the year, but because of those higher starting yields, you've been able to offset some of that with, some of the income generated. And, as I look at the Barclays Ag, which is, the broadest gauge of fixed income, is still up about 2.8% this year. So lots of volatility, but unlike the last 2 years when the fixed income portfolio was a drag on people's portfolios, this year you are seeing some positive sort of contributions, which ultimately is what you want to see from your fixed income portfolio.
Yeah, absolutely. All right. Well, I think, is there anything else you wanted to highlight for, looking back in 2024?
Yeah, I mean, a couple things just to highlight. I mean, we certainly as as an advisor, have a strong bias towards the U.S. And I think it's, again, a year where that's played out. I mean, if you think of the S&P, again, being up over 28%, a gauge for developed markets outside the U.S. would be the EFI index, which is up only 8%.
Right.
So, pretty significant difference of 20 percentage points there. Emerging markets did have a pretty sharp rally on the heels of some China stimulus announcements a few months back. So you saw, Chinese equities rally pretty sharply. China represents 25 to 28% of the emerging market benchmark. So emerging markets did rally on the heels of that, but that sort of petered out over the last, 2 months or so. And again, emerging markets are only up a little over 10% sort of year to date. So again, I highlight this U.S. exceptionalism and U.S. markets just continuing to outperform. But as I look across a performance sheet for 2024, virtually every asset class is positive for the year, which is, somewhat unique.
Right.
So, you want to preach diversification and everything, but, it's been a good year, obviously led by, U.S. equity markets have really been the star performers out there.
Yeah, agreed. So kind of taking those comments about the U.S. Equity markets continuing to be the top performer, what are your thoughts as we head into next year? A lot of the big institutions have come out with their projections for whether it's earnings growth or where the indices are going to end up. And, some of them are pretty conservative. I think we've seen a couple of the big ones come out with anywhere from like 3 to 5% for growth next year, or for growth on the stock market, I should reference. You read or about like the reversion to the mean. We're at pretty, we're high valuations and we've had strong returns in our markets the past few years. So what is the thinking at Conway on what are the opportunities in the U.S. equity markets going forward? And in particular, if we're looking at, like you said, the Magnificent Seven, or even going broader to, U.S. large cap growth.
Yeah, I mean, all great questions. Obviously, you hear a lot about valuations being a little bit more on the expensive side. I mean,
Mm-hmm.
the S&P 500 is currently trading at a, forward earnings multiple of about 22 times. I mean, that is above historical averages, pretty much across any time period you want to use. But I think one dynamic that we like to stress is the US versus really the rest of the world. We consider the US to be a pretty significant growth engine of the world.
Mm-hmm.
Our markets are very growth oriented, very growth driven, whereas outside the US, I think those markets tend to be, have less technology, less communication services, less exposure to sort of those growth sectors that are out there. They tend to be very much sort of value driven. So part of the rationale why U.S. markets can, continue to outperform is this idea that a lot of the tech companies, a lot of the innovation of, whether it's AI or, GLP-1s for weight loss drugs and things like that, all of that is occurring primarily in the U.S. And, a lot of it comes from these, large cap or mega cap, Mag 7 types of businesses that are out there. But with what we particularly like, even with valuations being a little bit more on the expensive side of things, the fact that the Fed is cutting rates right now and earnings are projected to rebound, call it 15% based on the latest expectations I've seen for 2025, we think that's a pretty favorable backdrop for, just U.S. equities in general. But the cautious side of me says that we haven't had 20% plus return years since the tech bubble. I'm not sure, what does next year hold? If you look at sort of long-term averages and your concept of mean reversion, long-term averages for sort of U.S. equities are in that, call it now, it's about a 10% range. So if we look over the last 10 years, the S&P is north of 13%. So that, based purely on sort of the science or statistics, you would suggest that it should be a more muted year for returns next year. But, of course, I think would feel pretty confident that, again, are you going to see a 20% return? I don't really know the answer to that, but I don't see anything out there that points to sort of negative returns or anything sort of on the horizon. I think it's important for people to remember that we've had one down month in all of 2024. That was actually in April. So it's been a very strong year.
Right.
Basically 10 of 11 months have been positive. We're positive, at least on the large cap side, in December through the first 4 days of December. But typically, I mean, you do see, 3 or so 5% corrections throughout a 13-month period. You typically are going to see at least a 10% correction on an annual basis. We haven't really experienced much of that. So, as markets digest some of the incoming policies, things like tariffs and immigration crackdowns and things like that, there is a chance that you could certainly see, some quick sort of market sell-offs that are out there. But it's important for people to take, again, that long-term perspective that we've had 2 really strong years in a row. We've had a decade of really strong performance that, corrections and things of that nature are healthy. But we think the fundamental backdrop for the U.S. remains, certainly very positive relative to the rest of the world.
Okay. And why don't we, I know you talked a little bit about, we are seeing some broadening of the markets, at least on the U.S. equity side, which I know you and I are in agreement is a healthy situation to be in. Do you want to maybe high level talk through, as we go into 2025, some of the asset class rankings that you and your team have put together? Again, I know you don't have the crystal ball, nor do I. We both wish we did. We'd be doing this on our own private island. But, maybe certain... I think our listeners know that certainly at Private Vista and in partnering with Conway, all of us are taking a long-term view for our clients' money that we have the responsibility for, and certainly do believe in diversification and asset allocation. Now, it doesn't mean we set it and forget it. As you mentioned, since our elections and President Trump returning back to the White House, we have seen some broadening where small caps have had a big rally. Maybe some other areas of the market. But can you high level either say areas, and I don't want to say outperform or underperform because I know we're not like calling it, if you will, but maybe we could look at it through the lens of potential opportunities and potential vulnerabilities.
Yeah. No, I think that's again a great point. I've talked about it a few times already. I think our asset allocation, our asset class rankings continue, at least from an equity standpoint, continue to point us towards U.S. equities
right.
over non-U.S. developed and emerging markets. Again, highlighting the fact that we think right now, we're coming off of, a couple quarters of near 3% growth. Atlanta Fed estimate for the fourth quarter is above, I think was 3.2% as of yesterday. With Trump coming back in office, and if he extends the 2017 tax cuts, that certainly could be positive. Things that could offset that are certainly tariffs, immigration policy could be negatives that are out there. But again, we sort of like the fact that the Fed is cutting rates, or at least has cut rates, and is recalibrating monetary policy at a time when earnings are rebounding, and we think that's a very positive backdrop for U.S. equities that are out there. Certainly there's interest rate sensitive parts of the market. Small caps tend to be more highly levered types of businesses. So as rates come down, theoretically that should benefit companies like that tend to borrow a little bit more than what you get out of like your mega cap stocks that have just tons of cash. So that could be positive for small caps. But, again, not all markets are created equal. We think it's important to really focus on, higher quality businesses that have earnings, are generating cash flows, things of that nature. Within the fixed income side of things, again, the bias would probably be towards, rates coming down a bit. But I think the overall thought here, as I think of it, is probably more of a range-bound sort of interest rate environment. The Fed has cut, but I think there is a lot of discussion about how much more should the Fed cut, just given how strong the economy, continues to be. Really,
Right.
The U.S. remains in a very resilient position that, if they continue to cut rates and do things like that, you could have another bout of inflation that could appear on the horizon. So you might be looking at an environment where they cut in December, but perhaps they, don't cut as much in 2025 as is expected. And, that could obviously lead to a little bit of a different outcome with, risk assets, equities, things of that nature. But, overall, fixed income wise, we do think, again, higher quality has always been the focus. We just don't think it's a time period where you need to really reach for yield and lower quality securities. Most of the default activity tends to occur in, loan markets or high yield in the CCC areas there. Again, lower quality
Right.
things. So, probably looking at another year of clipping coupons within fixed income, which I think is fine. And it's been a great environment because rates are higher now. So, fixed income actually for, your older population, if you can get, 4, 5, 6% sort of yields out there, you don't need to take as much risk in the equity market to achieve your, retirement goals of, generating a 5% return, whatever it, needs to be. So again, I think those are the sort of areas, but I think you hit on it at the beginning about, again, stressing diversification. We think having as many different return streams in a portfolio makes a lot of sense. We think, again, just given where we are, that spreads are tight within credit, valuations are certainly elevated, doesn't mean that they can't become more elevated.
Right.
But introducing things like alternatives, just other return streams in there, real estate, infrastructure, all those types of things that, might just give you more tools to sort of battle and, any uncertainty that might develop in 2025.
Yeah, I I think those are all good thoughts. One question, I know we get, and I'm sure you get it often too, is with, like you said, we've had back-to-back, well, knock on wood, we're hopefully going to be in back-to-back very positive years for the U.S. equity markets. We certainly are at this point in time of 2024. Oftentimes people will say, well, is it a good time to invest? Or, I can sit on cash and still in a money market, still get around like 4%. So it's liquid, it's still 4%. So a real rate of return. And either, do I wait till there's a pullback, or, we go into the, at some point we will go into a downturn on the market. So I know how I answer that, but I'm interested in your thoughts on, is it a good time to invest?
Yeah, I mean, I think, obviously it depends on everybody's risk tolerance, objectives, all that type of stuff has to come into play as part of that conversation. But I mean, ultimately, we do think it's near impossible to time markets. Right. So, we'd probably recommend maybe if you had $100 to allocate today, maybe you allocate a third right away, another third at some point in the future. And, that way you're sort of averaging into the markets, if you're concerned about things like valuations. Right. But I mean, if you're concerned about or trying to time a pullback, it may never happen. And then you're going to be kicking yourself and allocating capital 10, 20% higher. So, I mean, we think that, if you look at generally the statistics are, if you're trying to time markets, you're probably going to lose in that battle. But, not being invested on, I think we can all pull up the statistics, but, staying invested over the long term is really, the best strategy. So I think having a strategic plan and adhering to that strategic plan, again, we think it's, a good time to be allocating to, parts of the market like U.S. equities. And, I would just focus on areas that, we think are going to be higher quality and, good businesses that are generating cash flow. And, similarly on the fixed income side, you want similar strong corporate fundamentals in place, and just making sure you're just not taking on that undue risk right now. That's probably one thing that we would stress is you just don't need to take on that risk today. Just again, given where valuations are and given where spreads are from a, credit standpoint. But, again, I think if you look at things like the AI trade, the GLP-1 trade, I mean, perhaps things are a little bit ahead of themselves, but sure seems to me like there's an awful lot and an awful lot to do in the AI space for a very long time. And, my thoughts are we're probably in the early innings as opposed to the late innings. But, and if you believe in those themes and you believe in sort of U.S. equities and things of that nature, then it makes sense to just, I think to allocate with a long-term investment sort of horizon.
Yeah. All right. Well, I think kind of just to summarize for our listeners, kind of the key takeaways are, there's a lot happened in 2024. We still got a few weeks to go, so I'm sure we'll have some more things happen before we close out the year. Certainly, as we have our new administration actually come into office in early January, I think we're going to see a lot happening there. My guess is, as you referenced, we all know that the tax law is set to expire at the end of next year. So I would think that's probably going to be near the top of the agenda. Certainly watching what actually happens with the campaign talking points around tariffs and the mass deportations. I think 2025 is going to continue to be another action-packed year. But I think our takeaway for our listeners is, set your strategy, and it should be based on your individual situation, your timeframes, and what you're trying to accomplish. And once you've kind of set that overall strategy, the key thing is, unless something changes in your personal situation, really it should be one that you can ride out and stick with, both during when the markets are doing very well, and then certainly when we either have a temporary pullback or do go into the down part of the market cycle. So that, I think, is our key takeaway. Listeners, we know it's not sexy. That's why, I'm not on TV. I'm being a guest star on any of these. I'm not sure about you, Jeremy, but you and I both have been doing this for a long time, and kind of sticking with the strategy as long as it makes sense for you. Clearly making, you don't set it and forget it, making tweaks along the way. Some of the themes Jeremy highlighted was continuing to see, good opportunities in the U.S. markets. I know he called it U.S. exceptionalism. So we're not, topping out here on the markets. Also, though, on the fixed income side, stay higher quality credit. But, maybe making some tweaks along some of those sub asset classes. But really, if you can stick with your strategy, time has shown that that is kind of your best approach to managing your money individually. Jeremy, anything you want to add on as we wrap up here?
No, I think that was a great sort of overview and, thought process. Again, stick to your strategic plan. You can always have, good idea to rebalance and
right.
Have that, an appropriate amount of times every year, stick to your rebalancing plan. But, some tactical changes can be made along the way. But for the most part, I think sticking to, again, core fixed income, municipal bonds, higher quality credit are all going to make sense. And you're really getting paid now to own fixed income, unlike, sort of the decade of 0% interest rates. There really was no alternative to equities. Now
right.
You have an alternative, and building a diversified portfolio, you just have more drivers of returns taking place there. But, again, I think stay strategic, long-term investment horizon, and the worst time to ever reevaluate your risk tolerance is during a downturn. I know everybody, you want to make sure that you have your asset allocation and your strategic plan in place that allows you to sleep at night. The worst thing you can do is panic and during a market sell-off and,
right.
Pull money out or, whatever. You just want to make sure you have a portfolio that's built to weather that over, all time periods. I sort of point to that. Lots of different return streams, and that may include equities, fixed income, alternatives of some sort, just to be able to, have some winners even when like equities are selling off. And that, I think is really important to stress. But as much as we sort of try and predict what the Fed's going to do and what the, economic growth picture is going to look like, I mean, certainly as of now looks favorable, but again, we could see a Fed that doesn't do anything next year just based on stronger economic growth. But one thing that we always highlight here is the economic data constantly changes. We're one bad number away from maybe the Fed becoming more in play next year. That could be a jobs report that comes out well below expectations. It could be a bad GDP number. All of that is out there. So, again, markets move so quickly today that we just, again, stick to that long-term plan. It's too hard to time markets and too hard to really predict everything that's going to take place over the course of the year.
Yes. All right. Well, thank you so much for your time and sharing your insights today with our listeners. I very much appreciate it. And we are going to, for our listeners, we will revisit kind of at the end of January, our January 22nd episode. That's when it'll be released. We will be getting some insights from a fixed income or bond manager and then an equities manager. So we'll have a little bit more time of the administration being in place and seeing what they are going to prioritize and what the markets are doing at that point. So join us again more towards the end of January for kind of an update on some of the things that Jeremy and I discussed today. But Jeremy, thanks again for joining us. Appreciate it.
Yeah, thank you so much, Nicole, for having me, and wish everybody a happy holiday season coming up.
Yes. Yes, absolutely. We are in the throes of it. So I'm going to echo that as well to our listeners. I hope everyone is having a happy and healthy holiday season.
Yeah, thank you very much. That was an interesting conversation. The markets are a topic of nervous thinking for me. So it was nice to get your thoughts, Jeremy. And Nicole, for people who are listening to this podcast who might feel the same way I do, I might want to have a conversation with you. What's the best way for them to reach out and get a hold of you?
Yes. So they can go to our website, which is at myprivatevista.com. And on our homepage, there's a contact us button. Put in your information, reference this episode, and either myself or one of my wonderful colleagues will follow up with you, or you can call us at 312-831-4370. And our receptionist, again, can get you in contact with me or one of my wonderful colleagues.
Yeah, that's fantastic. And for those of you who are listening to this podcast and who are not yet subscribers, you can do something really easy. That is subscribe. Hit the follow button. Hit the subscribe button. And that way, every time Nicole drops a new episode, including the upcoming one in January, you'll be notified. You can give it a listen. You won't miss another episode. I would also ask that if you like this podcast, tell people about it. Share it with other folks. Word of mouth promotion is a very, very welcome tool and a very effective one too, as well. Until next time, I'm Bill Tucker. Thank you for taking the time to listen today. And I want to remind you that you can go out today and make today a great day or not. The choice is yours. Until next time.
Thank you for listening to the Dollars and Cents Creating Your Fulfilled Life with Nicole Romito, sponsored by Private Vista. Visit our website at www.myprivatevista.com or give us a call at 312-831-4370. And don't forget to click the follow button to be notified when new episodes become available. Private Vista is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is neither indicative nor a guarantee of future results. The investment opportunities referenced herein may not be suitable for all investors. All data or other information referenced herein is from sources believed to be reliable. Any opinions, news, research, analyses, prices, or other data or information contained in this presentation is provided as general market commentary and does not constitute investment advice. Private Vista and Hightower Advisors, LLC, or any of its affiliates make no representations or warranties expressed or implied as to the accuracy or completeness of the information or for statements or errors or omissions, or results obtained from the use of this information. Private Vista and Hightower Advisors, LLC assume no liability for action made or taken in reliance on or relating in any way to this information. The information is provided as of the date referenced. Such data and other information are subject to changes without notice. This was created for informational purposes only. The opinions expressed herein are solely those of the authors and do not represent those of Hightower Advisors, LLC, or any of its affiliates.